Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome to the Investor Coaching Show. Paul Winkler here, talking about the money world. Yeah. And educating while we're at it. Why not? I used to have this mentor. He would tell financial advisors they were talking about getting different degrees. And the advisors would be like, it's going to take me 4 or 5 years, to get that degree. I can't do that. And be like, well, 4 to 5 years, you're just going to be 4 to 5 years older anyway. You might as well learn something along the way. I thought it was good advice. That was, so then I got my Chartered Financial Consultant degree, Chartered Life Underwriter Training Council Fellow, Accredited Asset Management Specialist, Chartered Advisor for Senior Living, Registered Financial Consultant, Wealth Management Certified Professional. I just thought, why not collect degrees? I'm not even at the end of it yet, but anyway, you get the point. I love education, and so that's kind of what we do around here: educate, help you understand a little bit more about the investing world. My son and I got in a conversation. And, I thought I would share that with you just because, he was trying to understand, going through economics classes and just trying to understand a little bit about investing, watching a movie that I was kind of surprised he was watching, the Big Short. I guess I remember it was so long ago that I had actually seen that. It's been a while, but it was about these guys that had shorted mortgage-backed securities and the whole thing. The premise of the movie is they got really rich predicting the 2008-2009 stock market debacle. And, of course, what happened was that we had this big downturn in the market. And with the downturn in the market, they made a lot of money. You go, well, how do you make money when the market goes down? Well, short. You can short. And, he wanted to understand a little bit about how that worked. So let me just explain this to you just in the way that I did with him and help you understand a little bit about mortgage-backed securities and these types of things. When we're investing, one of the things that we look for in our portfolio are areas of growth, potential growth. We look at stocks and we look at, bonds and these different types of things. Now, sometimes people try to get into other commodities. And a commodity would be gold, silver, even currencies, and they try to get in currencies or, like cryptocurrencies and things like that. And I often go, you know what, it's not an investment because there is nobody paying to use your money. Now, when I have gold, it just goes up and down in value based on supply and demand for gold. If somebody wants to pay more for it than you paid for it for whatever reason, then you can make money. But you've got to hope that somebody wants to pay more for it. You're not getting anything else. You're not getting dividends. You're not getting any kind of interest payments. You're not getting any rental payments or anything like that. Matter of fact, you have to pay to store it, a lot of these things. And, and here's the thing is that when I buy a stock, what I'm buying is the right to receive the earnings on that company from here into the future. Now, so you think about it. Let's say if I told you I was going to pay you $1, but I wasn't going to pay you the $1 for a year from now, and there's a high likelihood that I was going to pay you the $1, but it might be 90 cents, it might be 80 cents, it might be $1.10, it might be, you're uncertain as to what you're going to get. You're going to go, you know what, I'll pay you today for the right to receive that money in the future, but I really have to think about how much I'm willing to pay you. So if I'm going to receive $1, but there's some uncertainty as to whether I'm going to really receive $1 or whether I'll receive 90 cents or whether I'll receive 80 cents or I might receive more than that, $1.10, then I would drop, because of the uncertainty, I would drop what I'm willing to pay for that $1 today. And I might say to you, I need about a 10% return. just to take this risk, because you may or may not come through in a year from now, and I might pay you 91 cents today to receive $1 in the future. Now, if you take 10% of 91 cents, it's about 9 cents, right? Just a little over. So if I take 91 plus 9, that gets me to $1. So if you do come through with that dollar a year from now, then I will be happy and go, hey, look, I made a 10% return. Now, if you come through and you actually pay me $1.10, you go, well, why would I pay you more? Well, this is where making this simple breaks down a little bit. But when you own a company, you're owning the rights to the profits, whatever they are. Now, if the profits come in higher than what you expected, then you're going to get a higher rate of return. I'm going to get more than $1 back a year from now, because remember, I'm using profits as my payment in the future. Now, how much more uncertain is it that when we're looking at earnings, not just a year from now, but 2 years from now, what earnings will be 3 years from now or 4 years from now, and then it starts to get really cloudy. We look through the glass dimly, and we don't really know what that money is going to be walking through the door. So what we do is we discount what we're willing to pay for something because of that level of uncertainty. I will pay a lower amount, 91 cents in my example, for the right to receive $1, hopefully, in a year from now. Now, if I only receive 80 cents, I lost money, right? So there's the risk factor in all of this. Now, with a company, what happens is if, let's say, the earnings come in lower than what was expected, you as the person that was giving the 91 cents to receive the $1 are going to be a little bit mad. And you're going to go, you know what, I'm not so happy about these circumstances. And you, the CEO, who was responsible for the business plan, you're the coach, like the coach for the football team calling the plays. You're the one that is going to go now. Bye-bye, you're out of here. I want somebody running this company that is more likely to come in with the earnings and come in with the $1 a year from now. So what'll happen is, you as a CEO, or whoever the CEO is going to be really, really conscious of making sure that they come through as best they can. And if they can't, then of course you hear people about, laying off people and lowering or reducing the workforce and, reducing expenses so that those earnings can walk through the door. Okay? So that is what happens with the stock market. When we look at buying stocks, we're buying the rights to those earnings into the future. When we buy, let's say, mortgages, and that's what my son and I were talking about. We were talking about mortgages. I'm buying the right to receive the payments on the mortgage in the future. Of course, payments with interest, right? It's going to be a stream of payments. So if I buy a 30-year mortgage off of a bank, I'll have 30 years of payments. And of course, the interest, as many people know, are a greater percentage of the total payments. You might have a $300,000 mortgage, and maybe you have $800,000 of payments that come in, and 3 of it was the repayment of the loan, and the other $500,000 was the interest on it. And just making up numbers, just so you get the idea behind it. So I'm buying the rights to receive those payments, right? Well, have you ever had a mortgage? I was explaining this to him. I said, have you ever had? He hasn't had a mortgage, but I'm saying to you, the audience, have you ever had a mortgage where that mortgage payment or the mortgage payment was redirected someplace else? Let's say that the bank sold the mortgage. And a lot of you probably within the sound of my voice have had that happen before, where they come in and say, hey, this so-and-so is servicing your mortgage. Well, banks will often sell those mortgages, because they made money setting up the mortgage, the closing costs and all the expenses on the front end, setting up the mortgage. Then they sell the rights to receive the payment back on that mortgage to somebody else. So another entity would pay a large sum of money to receive all those payments. Now, how do they figure out what they're willing to pay to receive those payments? They have to look at the future value, future payment stream, And I'm just using that one example of $1. I'm going to get $1 a year from now. And they may come in and say, well, there's one mortgage payment left and it's $1 and it's going to come in a year from now. I'll pay 90 cents for it, just 91 cents for it. So just use the same analogy. So what happens, they come up with this idea of how much to pay for it. And then what they'll do is they'll set up a mutual fund, maybe. You might have a mutual fund or an ETF that takes mortgages from all these different banks all over the country, and they put them and securitize them. They turn them into a security that people will buy, because what's a mutual fund? We take all our money, we drop it in a bucket, we stick it all in a bucket, and then what we do is we spread it out. Instead of, maybe I can afford to invest and buy one person's mortgage. But if I collectively do that with a lot of different people, I might have hundreds and hundreds of mortgages or thousands of mortgages that we're investing in. And then what happens is people make their mortgage payments, and when those mortgage payments come in, then I, as the owner of that mutual fund, have a proportionate share of the value of that payment that comes in. It's mine. So you think about that. If I own one millionth of the mutual fund, let's say, then one millionth of those payments that come in is mine. So it's not too hard to gather and understand. Well, what was going on in 2008, early 2009, was this whole thing that people are looking at their homes and they're going, man, the home's dropping in value and the mortgage is staying the same. And, I might have a $300,000 mortgage on something, on a piece of property that's only worth $200,000. And people just go, well, I can't pay. Lost my job. Times are tough, whatever. I can't make a payment. And then what they do is they default on it. And the bank's sitting there going, what do we do with this piece of property? We had collateralized loan. And, we lent the money on this thing, but if we sell the property, we're going to get back less than we lent out for the person that bought the home, right? Now, when you're shorting, this is the kind of situation you're hoping for. You're hoping that these people can't make their mortgage payments and that basket of mortgages is worth less. So if it's worth less, then what happens is, let's say that it was worth, I use the example with him. I said, let's say that the mortgages were worth $5. Let's say that that's what they were worth. And when they were bought, somebody buys them for $5, the bank securitizes them, and then they're worth $5. What we're hoping for is maybe that they'll go down to $3, that they're only worth $3. And because people are making payments on their mortgages, they're defaulting on it, the properties that are backing them are worth less, and they're only worth $3. And you're going, well, I just lost $2. Well, if you're the person shorting, what you did is you bought them, or you borrowed them, when they were worth $5. You borrowed them, and then you sold them. You had a security, and it's kind of like that. When you think about when I have a stock certificate, maybe I own a share of Home Depot, and I own one millionth of the company, let's say, and I own one share of the company, let's say, just to use a simple, easy to understand example. That little piece of paper, well, there's another 999,999 of those someplace else, because there are a million of them, a million shares. The company is broken up into a million parts, and what I'm hanging on to is one of those shares. And I don't care if somebody gives me a different share, it's still one millionth. So I'm indifferent. That piece of paper is just a piece of paper. If I can sell that piece of paper for whatever the market will give me right now for that piece of paper, and if I can wait it out, and hopefully over the next few months, that piece of paper, it can be repurchased at a lower price. So in my mortgage example, it's $5, and it goes down in value to $3. I can go and buy it, take the $5 that I got when I sold the shares at $5, and I can rebuy it at $3. Then what I can do is I can make I can say, hey, here's your piece of paper back, from whoever I borrowed it from. And then what they'll do is they'll go, oh, thank you for my piece of paper. And, they'll go, well, okay, ooh, man, look at this. I made I made a couple bucks. I sold it for $5. I rebought it for $3. I gave him back his piece of paper, because I just paid $3 for that same piece of paper. And he didn't know any different between one piece of paper and another, the person I borrowed it from. And then now I have made a couple of bucks. And that is shorting anything. That's the idea behind it. Now, what happens is you have to have a period of time that elapses, and that period of time is limited. So sometimes you'll hear people covering their shorts. So let's use a different example and say that $5 is what I sold those mortgage-backed securities for. And then what happened is they went up to $7 and I had to cover the short. I'm like going, oh, crud. I sold it for $5. I've got $5. Now I got to pay $7 to replace the piece of paper. Now I've got a problem. I have lost money. It cost me $2 to do this little deal. That is really why that whole thing made such a good movie, because literally they had a very short period of time, or they would have been out of business, bankrupt. They would have been in an absolute financial mess if those mortgage-backed securities did not drop in value. So this is highly risky. And you think about it, you have to be really certain something is going to go down in value. But here's the thing about the stock market all the time. You hear people making predictions about the stock market. What's going to do? Where's it going to go this year? What's going to happen? The S&P going to continue to go up, or the Magnificent Seven going to continue to go, whatever. What you have to do is make a bet against typically markets going up, which is about 3/4 of the time. So you have to be literally in that, you have to have a situation where it goes down in value, and it goes down precipitously enough where you can cover the cost of doing this little deal. But most of the time stock markets go up, so it's very, very risky to short things. This is why, if you look at my personal investment portfolio, I don't do any shorting, nothing, zero. It's all held long is what we call it. So sometimes you'll hear owning securities long. And that means that I actually own them. Now, I benefit if they go up in value. Now, if they go down in value, I just wait it out, because historically it always comes back. But that is the idea behind shorting. Now, mortgages, when you look at that and say, should I even own something like that in my investment portfolio? Number one, I'm not getting this money back in some cases for many years, many decades even. And the idea behind fixed income investments, bonds, and anything that pays interest like a mortgage would or a bond would or anything like that, the idea is safety. And now when I push that period of time that far out before I might likely get my money back, when I push it out that far, now I am taking significant risk, because if interest rates go up, they can drop down in value. And that's exactly what you saw happen in banks this year. A lot of banks got into some really bad hot water because they actually owned a lot of securities where it was many years before they were actually going to mature. And since it was going to be a long time before they mature, they dropped down in value when interest rates went back up. So, and with interest rates, having come down toward the end of the year, that has been helpful for some of those banks. But, when people panic and they want their money back, they're not trying to go, hey, maybe I'll just wait this out. People put their money in banks because they want safety. And then when all of a sudden safety is the last thing that they actually saw, when those mortgages and those bonds, that the banks held, when those bonds went down in value, then they panicked, and all of a sudden that put the banks in some really, really precarious position. And that's where you had all of those problems. So anyway, I hope you understand a little bit more about that, how that works. But, just understanding the stock market, if you think about it in that term, and you start to understand that the value for the stocks, or the value for anything that you buy like that has a cost of capital, where they're either paying you interest or dividends, which is part of earnings, or rental payments in the form of housing or something like that. Your value being the present value of that stream that's going to come in the future, that gives you an idea why I say that commodities like gold and silver and cryptocurrencies and those types of things, they're not investments, because you don't have that stream of income that you're buying that's going to be walking in the door. Your only hope is that somebody will pay more for something than you paid for it. Very, very rocky ground to stand on. That is why you'll often hear me talk against it as an investment. I'm not telling you it can't go up in value. They can. They can go up and down in all sorts of ways. But it is not, you're not getting the rights to some kind of payments in the future. And remember, the payments can be lower or they can be higher if a company's profits are higher in the future than what was projected. Hey guys, if you want specific advice for your unique situation, schedule a free 15-minute phone chat with one of our trusted advisors by going to paulwinkler.com/call. We don't sell any products, and our advisors don't make any commissions, so this isn't a sales call. We have a coaching process that helps you understand investing and relax about money. Don't put blind trust in anyone with your financial assets. We want to partner with you in the process so you know what you're doing and why. We manage assets on a fee-only basis, which means that when you do well, we do well, which aligns our interests with yours from the start. We also bring you into the financial planning process that gives you a clear plan so you can find the freedom to pursue your purpose. All our advisors are degreed planners too, with years of experience. So schedule a free 15-minute phone call with an advisor by going to paulwinkler.com/call. So Michael handed me something. The question that somebody had, Alan, thanks for the question. paulwinkler.com/question is one of the ways to ask things that you want me to cover here on the show that might be just curiosity questions, maybe something you just always wanted to understand. paulwinkler.com/question. The other way to go is just to the website. You can go to the website, paulwinkler.com, and you can submit questions there. It's somewhere on there. It's not that hard to find. But I don't have it in front of me. But anyway, Alan is asking, says, let's see, Paul, I hear this investment advisor talk about Bank of America going digital soon, and that President Biden would direct us onto the path maybe as soon as the end of January of 2024. Basically states, be aware of losing money during this switch. Why would folks lose money transferring from paper in coins to digital funds? I don't know. I hear people say stuff and I go, wow, where did they get that one? That's really creative. Especially seeing as a lot of our currency is already digital. When you go back in time, we used to have physical currency that we always dealt with. If you went and bought or sold something, you had a physical currency, and it was always convenience. So what happened, you would take an amount of gold, let's say, and it would be held. And then instead of walking around with gold, certificates were issued that you could use that were as good as the gold, so to speak. And when you wanted to turn your certificates, your pieces of paper in for the gold, you could do that. You could say, here's my paper, give me the gold that's the equivalent of this certificate. Now, of course, we went away from the gold standard, and that's a whole different conversation I've talked about many times before as to why we've done that. There are some really good reasons to do it. But in essence, that is what currency is. It's just a convenient way to buy and sell things, and it represents something. Now, if we look at this going digital currency, we have gone digitally in that you have this concept of velocity of money where dollars are replicated through this process, and it's too complex. I probably shouldn't even get into it right here, so I'm going to hesitate to jump into that. But if you look at some countries around the world, there are some countries around the world that are on an old system that there's still physical money is the main way they buy and sell things. And, in those countries, they're pretty backward as far as economically. It doesn't work terribly well. And that's why more advanced economies don't do that. More of the money is in digital form. Like when you go and you buy something, use your credit card and money is flowing between different bank accounts. You ever done that where you just move money from one bank account to another? You're not physically walking over there and grabbing a bunch of dollars and carrying it from bank A to bank B. It's just a digital, it's a representation. And it's kind of funny because this is something else I was talking to my son. And I says, it's kind of cool you think about it. People underestimate and they don't give enough credit to the rule of law and how important it is that we have military and we have police and we have people that protect our rights to own property. but it's what makes the whole system work, and what makes everybody better off is this property ownership. And part of it is a digital system. You think, wow, that's kind of a little bit precarious in a way, but our whole system, financial system, is based on it. And the reality of it is somebody protecting your right to own your home, even because your home is just a deed, right? So, well, I got my home, I own my home. Well, the reason that you can keep your stuff is because you can call police and go, hey, can you guys come on over here? Somebody has broken in my home, or somebody's, he's parked out and living in my living room, and you think it's kind of cool. I mean, we don't even think about how cool it is that we have people that will protect our right to own property. So back to this whole Bank of America thing, or, what he's talking about here, going digital soon. There are a lot of banks that are doing it. Bank of America, JP Morgan. There are a lot of banks, and what they're trying to do is set up a digital wallet, kind of like Apple Pay. Is really what it is. So, the ability to buy and sell, a lot of these banks are working on digital wallet, and it links the debit and credit cards, and it's a way to compete with Apple Pay and PayPal and those types of things that have been around for quite a while, because what happens is banking systems make money on providing services. But if you have more convenient ways of doing things, making it simpler for you to buy and sell and move money around, and you have the Wall Street Journal talks about this as well. But digital wallet, there was an article in CNBC, and I'm just going to grab that real quick because it has a couple things in here that I think would be helpful for you. It says, according to Wall Street Journal, the digital wallet could be operated by Early Warning Services, a joint venture with several banks that also run Zelle, because a lot of you have used Zelle, a digital way to move money that way. Major banks involved include Wells Fargo, JP Morgan Chase, Bank of America, and these different entities are just looking at ways to provide services that otherwise aren't out there for consumers. Now, what you'll find that happens, though, is people will run with this information to try to scare people into doing things that are in their best interest. Like maybe, I don't know who the financial person is or what they are or anything like that, but a lot of people will use fear to try to get people to buy or to use their services or buy the gold from them or buy, some other type of investment that is supposedly going to protect them from whatever calamity. And we know that fear actually motivates behavior far better than the hope for gain does. So what I'm seeing a lot of is this whole idea behind digital going to that. There is the talk about the Fed. I've talked about this several times before in different Federal Reserves around the world. There are a lot of digital currencies being worked on all around the world. China had their own. But the problem that you run into is privacy issues, and this is really the big holdup. Why it's really being talked about stage, but how do you protect people's rights to privacy is really the big hang-up regarding all of that. But the idea of having a digital way of moving money around is old. It's been around for quite a while. And, it makes our systems a lot more efficient. Now, another thing that holds it up as well, and part of the reason the banks are getting involved in some of this stuff, in my humble opinion, is they're seeing the writing on the wall that if we go digital in many different ways, you could bypass the banking system. They want to still remain relevant, involved in the payment process. So therefore, what happens is you'll have a big lobby called the banking system fighting against any kind of move that actually makes them irrelevant. So where will it go? Why would you lose money? I mean, think about it that way. Let me go back to that question. In essence, talk a little bit about that, because anytime that you change a currency, and currencies have been changed in different countries around the world, and you see a country that goes from one currency to another, what they do is they give a certain period of time, is typically the way I've seen it. They give a period of time that you can turn in your currency that you have, the old currency, for the new thing. So if I have $10, and let's say that we go to 10 Ameridollars is going to be the equivalent currency. I have a certain period of time to turn in my $10 because I won't be able to buy things with dollars anymore, let's say. Let's say that's what happens. I'm just making this up. This isn't happening, okay? But if I do that, I have so much time in which to turn in my $10 to get my Ameridollars because the Ameridollars are going to be more efficient. Now, in this particular case, it's probably going to be a whole lot easier if they ever go to a digital because they'll just say, hey, those physical dollars are the only thing you have to turn in. Your bank account that has $100,000 in it is going to be automatically converted to the new currency that we're just calling Ameridollars or whatever. I'm just, like I said, making up names. Don't panic. But if you have a bunch of cash sitting in your safe, and this is one of the things that people are like, oh my goodness, and then they're going to know how much cash I've got sitting in my safe. And I've had this happen before. Man, I've been in this business so long, I've seen everything. I remember having this one person had well over $100,000 in mattresses and all of this stuff. And like, how do I turn this stuff in? I said, oh, where'd you get that money? It was money I earned that I didn't pay taxes on. And so it was, you go and walk into a bank and go, I got $100,000 in bills, and they're going to wonder where on earth you got it, right? So it can create a problem when you go underground in the system and you avoid the taxation system. But the reality of it is most of us, if we have any cash sitting in our safes or anything like that, it's a relatively small amount, and you just hand that in, and then you get credit in the bank account for whatever that is. So if I have $1,000 in 20s, let's say I walk in and go, here, this $1,000 in 20s, give me that a credit amount in my account in digital dollars. And when I made that comment jokingly and kind of going, yeah, how are you going to lose money? I find that people just make up stuff, and I don't. There's no basis in truth or basis in any kind of objective. This is what's going to happen, and this is what they're talking about doing. It's just they make up stuff, and it scares people, and then people start asking questions about it. So, I don't know. Those types of things, I hear those types of stories out there, and it just frustrates me more than anything. Just going, oh gosh, here we go, trying to scare people again. And I've heard it, I've been doing this for well over 30 years, and I've heard so many of them that haven't happened. It's kind of like, the climate scares, same type of stuff. Where people go, this is going to happen, it's going to happen, and I've heard that for well over 50 years. And whatever dire prediction that they come up with doesn't happen, and then all of a sudden they're off predicting something else. Because they've made their money scaring people with the first prediction. Now all they have to do is keep, coming up with something else new for you to worry about. Well, that's why our big thing is just relax about money. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.